Hello. I'm joined today by Giovanni Sabotini, the General Manager of the Italian Banking Association, the ABI. Mr. Sabotini, welcome to the FT. Thanks for joining us.
Thank you very much for the invitation.
You've come at a very interesting time for the banking sector in general, but also for Italy in particular. The Eurozone is going through a pretty deep crisis. What's your perception of where we are in that crisis and whether there's any sign of it ending?
Well, I think that from last Friday, after the declaration of the European Council, I'm starting to be a little bit more optimistic. To restore confidence in the euro, we need political responses. And finally, at the Friday meeting, we had the first sign of a unified, strong response from the EU leaders.
There was particular excitement, I suppose, in some policy circles about the banking union idea. How crucial was that, do you think?
Well, we are very supportive of this proposal of a banking union. I think that this is something really needed to promote the integration of European financial markets. One of the bad outcomes of the crisis was an attitude from some regulators to ring-fence their supervised entity, bringing some fragmentation in the European financial markets. This is very detrimental. And also, we often highlighted that we have a problem of not sufficient harmonized supervisory practices across Europe. I think that Italy is a good example where a very strict supervision from Bank of Italy avoided a lot of the problem that happened in other European countries.
In Italy, what do you see as the risks to the banking industry?
Well, the problem is exactly the opposite as in Spain. For the time being, the increased risk that market attached to Italian banks stems from the increased risk attached to the Italian risk, to Italy risk, which is the opposite in Spain, where the bank were the problem that increased the risk for Spain.
Right.
I think that for the time, well, during the crisis, the Italian banks clearly demonstrated that they are more resilient than most of their European peers. No Italian banks has been saved by the use of public money, compared with 2,000 trillion euros used to save banks in UK, Germany.
One final question on a completely different topic, that of LIBOR, the London Interbank Offered Rate, and the interbank lending markets. Now, Barclays has been in the news this week over its handling of that issue, settling with the regulators, and it's led basically to the top 3 people at the bank leaving. Do you have broader concerns of the ramifications from that LIBOR probe across the European banking markets, in particular in Italy, in your case?
Well, it's very difficult to express a judgment taking into account that the investigation is ongoing. What I can say is that no Italian bank is involved in this investigation, and I think that also this kind of misbehavior is very far from the banking culture of Italian banks. We are basically commercial banks. 60% of our assets are represented by loans to households and corporations, and therefore there are less incentive to misbehave. The amount of proprietary trading for Italian banks is really minimal. So I think that this investigation will not affect Italian banks.
Mr. Sabotini, thank you very much.
My pleasure. Thank you very much.